Good day, fellow investors. A great comment here on how much cash to hold going into 2025. We have discussed Warren Buffett going totally into cash, selling practically whatever he can sell and get liquidity, Apple position mostly, but 300 billion, the last time he did that was before the great financial crisis, so he might be predicting a crash, and that's why he went to cash. And I want to discuss in this video the 4 key components of cash: yield, inflation, opportunity cost, and opportunity potential, so that you can make your own decision on how much cash, 3% treasury, 4% treasury, short-term treasury like Buffett, to hold. Let's immediately start with US treasury yields, and for the first time in a decade, US Treasury yields are going towards the positive side. The real yields are 1.28 and the nominal yield is 4.5%. If we look at the Treasury yield curve, the current one, it's pretty much flattish, so 10-year is similar to shorter term, even if the 10-year, the longer term, the tail of the bond market has been going up on more risks of inflation. And that's exactly the recent news. US yields hit 14-month high despite the Fed lowering rates. Thus, the market is not agreeing on the Fed's potential to lower rates further. And Warren Buffett owns just these short-term bonds here, 3-month bonds, because he has liquidity and he has no risk of long-term inflation erosion. And if we look at our quadrant, this is a very low risk situation for Buffett. Okay, he will get 1% real return, nominal 4%, but he can exchange that for other opportunities. But inflation is the key cost of holding cash, because at 2.7%, if you get 3-4% on your cash, the reality is most likely zero. So it gives you zero real returns, but it gives you an opportunity to buy something in the future, or it gives you an opportunity cost if you miss buying. So 1% real yield on 3% inflation, 4% nominal yield. That's the situation there. The positive is that there is no risk. So you hold cash, you cannot lose cash. But let's now discuss the opportunity cost. If we look at Berkshire's cash pile, let's just take 2020, it was already at 150 billion. If Warren Buffett had put that into the S&P 500, it would be a 2x, 50 billion for, let's say, insurance. He just lost 100 billion by putting it into treasuries. He was getting 0 for 2 years. Then let's say 2% for a year and 4 or 5% for the last 2 years. Warren Buffett got 12% in total. Inflation was likely 15%. The S&P 500 doubled in the meantime. Buffett lost 100 billion for his shareholders. Why does Buffett go into cash? For the future potential opportunity and for avoiding the risk of the market, because the market can crash 50%. Your cash can't. And this is exactly what Warren Buffett did in 2009. When the markets crashed, he had the billions to buy Burlington Northern, and by Bloomberg, already by 2014, he get all his cash back through dividends from Burlington Northern. So when it comes to how much cash to hold, you can be long stocks and then spend that part of cash on hedging, which is something we'll likely discuss next week, options, other potential hedges. I own a business that if the market crashes will make more money. Thus, that is a hedge for me. But the key question is, how much cash you should hold is how much makes you sleep well. Value investing is about risk first, so you look at your portfolio, what can go wrong? Can everything crash 50%? Am I okay with that? Am I okay with more income adding, more dividends, reinvesting at a cheaper price? Cheaper prices make value investors happier. That's value investing. Am I hedged in any way? Nobody can predict the markets, so the markets can go another 2x going forward. Can you watch that from a cash perspective? If the markets go 2x next 5 years, my business will make 5 to 10% per year, and I'm happy with that, and I'm happy to look at the markets outperforming if that happens. If the markets crash 50%, I keep on my compounding. Higher or slower rates, I want to compound for certainty, and that's value investing. So you can go into cash, you get your 4%, and then if something crashes, then you take advantage of that opportunity. So the key question lies within yourself. You have to ask yourself, what are your financial goals? How would the potential Buffett predicted crash of 50% hit your financial goals? If you are destroyed by a 50% crash, then you need to go into cash. If you can keep accumulating, investing in stocks for decades to come, then you might have more risk tolerance, and you have to see where what fits you. So the answer, unfortunately, if you expected more, lies within you. You can also check my research platform, what I'm doing, how I think I'm, let's say, partially hedged, and also taking advantage of the growth of the markets there. I always like to think in both. Unfortunately, can't discuss that on YouTube.